Everyone for joining today's webinar, and at this time I'd like to turn it over to Jim.
Good morning, everybody. My name is Jim DeCenzo. I am the National Director of HBK Manufacturing Solutions, and we are here today for the June edition of our monthly webinar. Today we're going to be joined by Brian Coddington and Al Schmidt from Source Advisors, and the topic today is going to be an update on 174 rules related to amortization and the R&D credit, which has been a topic that has been at the top of our minds for the last several months. And again, just to recap for everybody, and I'm sure Brian will fill you in more in greater detail. 174 requires amortization of costs that previously were able to be expensed. And we, as a profession and business owners, for the last several years, were thinking that this would be reversed. It has not. Brian will go into detail about that. And so we are now faced with some very unfavorable rules related to costs that, as I mentioned, it could previously be expensed. There have been a lot of ups and downs as we follow this, thinking that there might be some legislation passed. As recently as about 10 days ago, I had given up hope, and then sure enough, there was some legislation introduced that may be a solution for this. So I think it's a really timely topic. I thank everybody for joining. And if you have questions, please, throughout the course of, as we speak, as Brian does the majority of the speaking, don't hesitate to post them to the team chat. And with that, I'm going to turn it over to Brian. Brian is he's a senior director of accounting methods and credits at Source Advisors. We have worked with Source Advisors for a long time, and they are a very, very credible and very strong organization, and so that's why we asked them to join us, because they have a lot of understanding of these Section 174 amortization rules, and also some insight as to maybe what we could see going forward. So with that, I'm going to turn it over to Brian and let him go from there.
Thank you, Jim. So today I'm going to talk about Section 174 amortization, which it's a thrilling topic. It really is. I'm sure most of you wish you'd never heard of it, and I agree with you there. So high level, we're going to have a straightforward agenda. We're going to talk about what changed in the TCJA 5 years ago. We're going to talk about the relationship between the research credit and this amortization provision. We're going to talk about all the uncertain areas, well, not all of them, but the most prominent ones. We're going to talk about software developers because, like it or not, almost every company, either in-house or using contractors, is a software developer these days, to at least some extent. We're going to go through some examples of how the credit and the amortization provisions interact. Then we're going to cover the procedural guidance and any updates we have. So who's impacted? This is a pretty simple question. Everyone who does research and software development is impacted. We've highlighted a few companies that, people may not think of as being impacted, such as software development, video game developers, and financial services, but we're talking about manufacturing today. And manufacturing, if you're in the business, the modern business environment where you are having to continuously reinvent processes and products to stay competitive, you can be impacted. So what happened? Well, let's roll back the clock. We can start in 2017, but it's probably best if we start almost a century ago in the late 1920s. And starting in the 1920s, the courts were faced with a problem. They had this new thing called the Internal Revenue Act, from 1916, and companies with existing research departments that were developing new products and improving their existing processes were faced with, well, how do we actually account for these things? And over several decades, this is what emerged. If you had research, it was an intangible asset, of course. Research and development in general was viewed as an intangible. You capitalize the costs of development, and then when you begin to realize benefits from it, if it has a determinable useful life, you could amortize it. And if it didn't have a determinable useful life, or you couldn't show when you start to realize benefits from it, guess what? It just sits on the book as a non-depreciable, non-amortizable capital asset until you get rid of the project or the business. People hated this. So in the 1950s, as GAAP was moving towards expensing for R&D costs, Congress got into the act and enacted Code Section 174. And it was a simple code section. It said, okay, if you have research or experimental costs, you can expense them when paid or incurred. You can capitalize them and amortize them over a period of no less than 60 months or 5 years, starting with when you first realize benefits from the research, or you can follow the old method of you put them on your books and leave them there forever. That's what we had. That was the primary incentive for research and development in the US for decades. It was even the subject of many tax shelters in the 1970s and early 80s. Then in 1981, we got the research credit. And since then, we've really focused on the research credit as the primary driver of innovation from a tax perspective. And most people forgot that we had this other provision. That all changed in 2017 when Congress said, hey, we need to pay for this massive tax cut we're passing, the Tax Cuts and Jobs Act. Let's change how we account for research expenses. Instead of expensing them, we're going to require taxpayers to capitalize them and amortize them over 5 years. And even worse, if it's a foreign research expense, it's going to be 15 years, not 5 years. Oh, and software development, that's now research by default. Now, they did a clever thing. The clever thing was that Congress, when they look at legislation, whether you're going to get a tax cut or a tax increase, they only look at a 10-year budget window to model those effects. So they said, okay, this is just a timing difference. I mean, you take, you can expense it all in year one, or you can expense it over 5 years. And from a cash perspective, assuming constant expenses, it's going to equal out, around 10 years. You'll raise as much and you'll in taxes as you'll lose. So they said, we're going to delay this 5 years so that we only get the income raising part, the revenue raising part of this in the budget window. So it looks like this huge tax increase. And oh yeah, we'll probably fix it before then. Well, as everyone knows, after 2017, Republicans lost control of the Senate. They were never able to fix this. And so we have this system. It's still there. Congress has not yet fixed it. Now, I should mention the research credit itself has not been changed directly. And if you have research, you have to amortize the costs of it, regardless of whether you claim the credit. It's a very crucial point. Some people have said, well, just stop claiming the research credit. And I understand why you'd want to do that. I'm sympathetic. But it doesn't put your company in a good position if you've claimed the research credit for years on Form 6765 up through 2021, and all of a sudden in 2022, absent a change in how you do business, you have no research anymore. no credit, no amortization. My viewpoint is if Congress doesn't fix it, that is painting a target on your back. So there are some good
Brian,
things.
if I could jump
Sure.
in here, that's one of the areas that, you know, when I first started talking to clients about the changes to 174 amortization, many of them, their first impulse was, well, I just won't claim that credit anymore. We'll just continue to deduct it. And like you said, talk about a target. You know, if I were the IRS, the first thing I would do if this goes through is I would look at companies that claimed the R&D credit in prior years and didn't claim the R&D credit in the current year and examine those. So that is not a reasonable option. Like you said, absent a dramatic change in your business, which is probably, I'm sure there are some out there, but not many. So.
Well, it is possible. I think of one client, one of my colleagues' clients. It's a small company. It's innovative, but its domestic spend on R&D has fallen in recent years. It used to be they had $100,000 credits. Now they have a less than $10,000 credit through 21, and they just were really reducing their domestic R&D spend. And so in theory, it wouldn't be surprising if that type of client, you know, in 2022, that number drops to zero because it was in line with what their business was already experiencing. Unfortunately, they develop software. They use overseas contractors to develop software for use in their business. And so they were actually put in a worse position because all of a sudden, you know, just domestically, they could have been fine. But now, because they use foreign contractors, they're looking at 15-year amortization for $500,000 in, you know, contract software development. It's, you know, that's just illustrative of the point that you really have to look at the facts and circumstances, and there are more changes than just what you were taking the credit on. So we did have some other changes back in the TCJA. We'll get into mathematical example this a little bit later, but in general, everyone who took the R&D credit on an original return would take the so-called reduced credit. See, back in the 80s, Congress figured out that people were taking research expenses, deducting them under 174, and using the same expenses to claim the research credit. They didn't like this. They thought it was double dipping, so they added a rule that said you have to reduce your research expenses by the amount of the credit. No double dipping. Well, they also provided an election around that. And they said, well, you can take a haircut on your research credit based on the top C Corp tax rate. And if you do that, if you elect this reduced research credit, you don't have to reduce your 174 expenses. Well, that was a better deal, especially since, you know, since the 1980s, we've had the huge sea change in the accounting industry where a lot of C Corps back in the 1980s, well, everyone's a pass-through now, practically speaking. And not everyone is, but seems like it. So C Corp rate is usually lower than the top rate on the individual income. So especially since the TCJA, where you have a 21% C Corp rate and a nominally 37% rate on individual income, it's very beneficial to elect the reduced credit. That's all changed in 2022. Congress changed the rules to where you almost never get an add back. And I'll get into more detail on that a little bit later. So that's a great thing. Another great thing, especially in the small and mid-sized business segment, is, you know, for a mid-sized business, it's not unusual to have a founder, engineer, software developer, something along those lines, who is working as an executive, but is still intimately involved in the research process. Well, for the last few decades, The research credit has incorporated Section 174's reasonableness requirement, which means if you have someone working as an engineer but making CEO wages, they can't always, the service won't always allow them on exam to claim their full wages for the research credit. They may have to reduce it to a reasonable amount for the engineering work. And, that's a theory. Services won on that in court, but, they won on the theory. They didn't win on the implementation. It's not as harsh as it sounds. And the big reason, this was a revenue raiser. Everything changed because this was supposed to raise $120 billion over 10 years. And that takes us to our first polling question.
Okay, for everybody that is desirous of getting CPE, please confirm your attendance, and then we can move on.
All right. Awesome. So moving on. So this was 2017 when everything changed, but it was delayed by 5 years. Where's Congress been? Why haven't they fixed this? Well, they've tried. In 2021, Congress introduced the Build Back Better Act. It would have delayed the effective date for this by 4 years, so through 2025. So this wouldn't have hit until 2026. At the time, the budget math of a delay said it'll cost only $6 billion. It'll cost $126 billion, but it'll raise $120 billion due to their budget math. So net cost $6 billion. I've been told by congressional aides that as of earlier in this year, that cost was down to $4 billion. Well, now Congress has a new version out. But so anyway, when Congress finally did pass a bill last year, it took them a whole year to get a bill through. The Inflation Reduction Act, there was no 174 fix. They did increase the research credit payroll tax credit, doubling it from $250 to $500K. And at the time, no one was worried. Everyone said, oh, well, it's too expensive. Midterm elections are coming up in November, and after the midterm elections, when we have the so-called lame duck session of Congress, where a bunch of those people are retiring or got voted out of office and aren't worried about political accountability anymore, they love to pass spending then. It's the furthest point from the next election. They'll fix it then. They love tax extenders that aren't paid for in lame duck sessions. Well, guess what? That didn't happen. All of us professional prognosticators had egg on our face. So we come to the new session of Congress this year, and there have been bills introduced in both the Senate and the House, bills that are supported on a bipartisan basis that would, if it was 174 was the only issue, would easily pass. But that's not how Congress works. 174 fix has been attached by the Republican caucus to another couple of business extenders, primarily extending 100% bonus depreciation beyond 2022 all the way through 2025. And if you're familiar with this provision, TCJA created a business interest deduction limit, which in, the main component is it's a limit of business interest deductions to 30% of what we can call tax EBITDA. But that's switched. It used to be tax EBITDA. You'd add back depreciation and amortization, but now it is tax EBIT in 2022 and beyond. The business extenders would also switch that back to tax EBITDA through 2025. And the Republicans, a couple of Fridays ago, actually introduced a new bill that would provide exactly those three extenders, as they're called, tax extenders. Well, it's going to pass the House at some point. It's going to go to the Senate. It's going to die there. Don't worry about that. It's an opening offer from House Republicans to the Senate. It will actually in some form or another come back later in the year attached as a tax title to some must-pass legislation. And there's must-pass legislation that's out there. The spending bill and the defense appropriations at the end of 2022 were only one-year bills. Every 5 years, the Farm Bill and the Federal Aviation Administration, they have to be reauthorized. And they only go through September 30th of this year. So we have 4 bills that are going to be passed at some point by Congress this year. They may all be one bill by the time it gets to the end of the year, but key point is we think this is going to be fixed still. There's the willpower to do it, but whether it can get through Congress and when it gets through Congress, that is the open question. Our anticipation is that it won't happen in time for the 9/15 filing deadline. I would love to be wrong. I really would. But I don't see this happening sooner than 9/15 or more likely after 10/15, late in the year. So
Brian, I'm gonna, if I could jump in again. So we've had, as I mentioned, we've had our ups and downs and thoughts on this, and a couple Fridays ago when those bills were introduced, I had literally just spoken to a client earlier that afternoon and said, I'm done. There's no hope, no hope for this. And then I found out Monday that those bills had been introduced on Friday. So if I heard you correctly, and I think I did, just to restate, you're still confident that there will be a change, just not in time for the 9/15 filings of extended returns.
Well, I'm an optimist at heart. I have this feeling where I would love to see Congress fix this summer. There's a will among both parties to fix it. Maybe they can pull out a miracle and actually work together. But I'm also a realist. I've seen how Congress has operated for most of the last 15 years, where the two parties can't come together to agree that the sky is blue. So taking both of those into account, I think they will eventually fix this, but it won't be in time for anyone who's filing for 2022. If you look at the most recent bill that the Republicans introduced, there are even provisions baked in that would only be relevant if they think it's going to be released after the filing deadline.
So let me ask you this. If there were a change post-filing deadline, is your thought that it would be retroactive to January 1, 2023, or is the thought that it would be prospective into 2024?
Based on the most recent bill and all the other bills that have been introduced, it would be retroactive to 1/1/2022. Now, how that actually gets implemented, the latest bill has an option. It looks like you'll be able to, as a company, you'd be able to amend your 22 return, or if you want to, you could elect to recognize a change in 2023. And depending on your facts and circumstances, either one of those might be preferable. If if the research expense isn't that great and there are a ton of K1s and 1040s to amend, then I could easily see waiting to recognize it in 23. But right now, it looks like it'll be retroactive to 2022, which is great news when it happens.
And I misspoke. I asked if it would be retroactive to 1/1/23. Of course, I meant 22.
Of course,
so
yeah.
That's good to know. Glad that you clarified that.
Yeah. So, but Congress isn't the only actor here. There's Treasury and the IRS. So, they're just like the rest of us in the industry. They sat around, didn't really talk about it, apparently in public at least, all that much until 2021. And the end of 2021, they started talking about this at conferences. And they said, oh, okay, yeah, we'll come out with something. And then as we head into 2022, oh yeah, we'll we'll get substantive and procedural guidance out. We'll get it by the end of the year. Well, originally they said by 9/15, but well, 9/15 of which year? There's a interesting tidbit of info there. So they got procedural guidance out last December. They said, this is how you adopt the new method. We're not going to tell you exactly what new method you have to adopt for amortization or what's included in the costs, but yeah, we're going to allow you to do it. Here's how. We have this easy strip down feature. It's great. You don't have to file 3115. You just have to attach a white paper election statement to your return, but only if you file for 22. If you try to delay the change, then you have to do the full 3115. Well, that was nice, but we have all this uncertainty about what is actually included in 174. So this is some real inside baseball here. But the IRS is struggling with the Inflation Reduction Act, which introduced tons or modified tons of these energy tax credits. And as luck would have it, the branch of the IRS Chief Counsel Office that handles tax credits like that is the same one that handles Section 174, the pass-throughs and special industries group. Well, because they're overwhelmed with tax credits, the IRS said, hey, we're going to reassign this project to the Income Tax and Accounting Office, to Branch 7. They used to handle 174, like 15 years ago. They have the expertise. It's great. So where we are sitting right now with Treasury is we actually informally provided comments to them in an hour-long session a couple of weeks ago, and they are trying to get out guidance, substantive guidance. It could be proposed regs, it could be IRS notices before the 9/15 filing deadline. And as recently as yesterday, one of my colleagues who's also trying to get in front of them to provide comments heard that is their top priority. Basically, they're really working hard to get guidance out as soon as possible. So I think the July to early August timeframe is possible. And based on the receptiveness to certain issues, I think a lot of people will be happy with the guidance. It's not perfect. It's not going to say you don't have to do 174 in 2022, but it should provide relief for some industries. And the nice thing is it's going to be prospective only, but they'll probably allow early application if they need it. So yes,
that
Jim?
says, you say that would be, the guidance would be issued by 9/15.
Mm-hmm.
I mean, that's great, but realistically, as practitioners and our clients, we can't really wait until.
Well, no, we can't wait till 9/15, and so
Right.
that's why it's really good news that they're probably they're going to try to get something out. I would suspect as early as next month. That gives us, as practitioners and as taxpayers, it gives us 2 months before the 9/15 filing deadline. And for certain companies where, depending on how the guidance comes out, they may be entirely exempt from 174, for them it would be great. Now, for everyone else where it's a pretty clear-cut case that they have research, there's no question. There may be some things that are favorable, some simplifying assumptions that can be used, but if you know you have research, nothing's going to change that. You should probably look at continuing on taking reasonable positions with your 2022 filing.
Okay, thanks.
So you're welcome. So you've heard me talk about Section 41 and 174 a lot. Well, they apply to costs, but what's the difference? Well, the research credit is Section 41, and it's pretty simple. It largely applies to 4 buckets of what we would typically call direct costs. And you get your W-2 box 1 wages for the people doing the direct research, the scientists, the developers, the engineers. You get the salaries, the box 1 wages for their first line managers who directly supervise the research. And then you also get the direct wages of the direct support. So not the janitor who cleans the entire building, but the lab assistants who wash the bottles for the chemists, they're included. Has to be direct support of research. Then there's another category that when I started in the research credit business, 16 years ago or so, this wasn't a big deal. It is now. Computer rental or lease costs. A lot of companies have moved their development environment or their testing, even their CAD programs perhaps, into cloud-based environments. And so cloud computing costs are now a big component of the research credit. If a company contracts out its research and owns the rights and risks to it, that IP rights, and they're at risk for the cost of the research, they get to claim 65% of subcontractor costs. And finally, if there are supplies that are used or consumed in the qualifying research activity, those are included in the credit. 174 is bigger than the credit. Its rules are less detailed. It includes the gross wages, includes overhead, office supplies, occupancy costs, patent costs, software licenses, utilities, and it's a very facts and circumstances driven cost accounting analysis. So that takes us to where the uncertain areas are. And the big one is what costs are included. I mean, yeah, you saw that nice little table I had, but the reality is most companies, if they're tracking R&D costs, and they're not a big private company or public company that has GAAP-based financials, they're only tracking qualified research expenses to take the research credit. They're not coming up with GAAP software development or R&D numbers. And so most companies, they're only looking at QREs in their books and records, and then only to claim the credit. Now, in the past, we used to do what so-called 174 studies because, well, some of those costs for research on the books, they get hung up in inventory, or they get hung up in the basis of a fixed asset. And so years ago, when 174 expensing was allowed, would occasionally do studies to say, we're going to take these costs out of inventory and put them into 174, and you get this big write-off. It was a nice thing. The opposite is true today. We don't want costs in 174. We want them in inventory or fixed assets where they get a quicker write-off. And even though the IRS has historically required an explicit 174 election, either on the first year return where you have research expenses or via Form 3115 when you've changed your accounting method, no one does that. No one tracks the 174 costs, especially the 174 costs beyond QREs on their tax returns. Virtually no one. So high level, what's included? The current regs say it's all costs incident to the development or improvement of a product. And they go on to specify that includes patent attorney costs. And the regs say, well, that includes indirect supplies, unlike the credit, includes testing. And, well, the regs don't really go much beyond that. Now, one of the, that's if we just look at the regs. One of the cool things is this is a decades-old provision. There's been guidance. And back in the late 60s, the IRS issued a revenue ruling to say, well, let's consider the case of a taxpayer. They've undertaken a research project. it qualifies as research under 174. After the project, they had to go into the IRS to get an accounting method change on how they account for research projects. And they also had to go to some other regulatory agency to get a determination letter. Do the accounting and legal costs that would not have happened except that they had engaged in R&D, are those included in 174? And the IRS says no, they're not. They're not because they are not incident to the development or improvement of a product. They wouldn't have happened but for the R&D project. So that tells us that if Treasury and the IRS are consistent with prior guidance, you don't have to include every cost that is caused or related to software development or research. Only things that are incident to the development or improvement are included. So that gives you a pretty good argument not to include everything under the sun. Now, the unfortunate part is, just a few years later, the IRS came and said, well, looking at a company that manufactures products, that company had an internal engineering department. Do we have to include the salary and overhead costs of that engineering department in 174? And the answer was yes. So unlike some have hoped for being able to exclude internal labor and overhead, if they're consistent, that's not going to happen. But how far that goes, remember, we still have that incident to test. So yes, you have to include the engineering labor and overhead, but what about, say, the cost of a human resources department? Does it come down to whether that's included in the burden rate or standard costs for the engineering department? They haven't provided that guidance. Treasury needs to. That's one of the things they're working on. Another really big issue, and this one pre-existed the amortization thing. This has been a big issue for years. Doesn't get talked about much though. If you have a time and materials contract or a cost plus contract, does a contractor or does their principal, the company hiring them, which one gets stuck with amortization? And the answer isn't really that simple. A lot of firms out there, a lot of the big accounting firms have looked at it as a simple matter. And they say, well, the research credit is a subset of Section 174. There are funding rules that look at IP rights and risk of loss in Section 41. Therefore, that's not in 174. Both these companies are subject to amortization. I don't actually like that answer. Most taxpayers don't like it, especially when one or the other company is just purely a service provider. And on the surface, we can ask, should we just follow the research credit rules and say IP ownership and risk of loss matter? And the answer is sorta. The 174 regulations do include risk in determining whether a service provider is subject to 174. And there is a private letter ruling from 1994 where in a certain circumstance, a certain contractual arrangement between a software developer and the company that hired them to develop the software, one of the companies had IP ownership, but was not at risk for the research. The other was at risk, but didn't have IP ownership. And the IRS ruled in that case, neither one of them gets hit with 174. Most circumstances with manufacturing, that's a pretty rare circumstances where you don't have one or the other. What Treasury has consistently said over the last couple of years is that their belief is that when you have a contractor and a principal like this, only one of the companies is generally going to be subject to amortization unless they have a cost sharing arrangement, such as under the transfer pricing rules. And because of that, this matters even if amortization goes away, because This matters for foreign tax purposes. So if you have multinational operations, this could be a big issue for you. So this is something they're also working on. And this is also an area where, depending on the facts and circumstances, companies engaged in contract research may have an opportunity, given existing guidance, to avoid the impact of 174 if their facts are right. This is probably the area where we can get rid of a lot of companies who might otherwise be subject to 174 because they're nominally doing research. Well, if they don't own the IP and they're not at risk of loss for the research because they're under a cost plus contract, they may not be a research company. And there are also other arguments that it would say, for instance, it's not in connection with their trade and business, it's connection with the trade or business of the company that hired them. So there are options there. And that takes us to our next polling question. So please confirm your attendance, everyone. All right, so going to rush through this section a little. So historically, software developers were allowed 3 options on how to treat software. They can amortize it over 60 months, that's 5 years from when they finished it. They can amortize it over 36 months from the date they place in service, or they could treat the cost of software development as expenses in the year paid or incurred. By default, all software development costs are now 174 expenditures. This is another area where the Treasury has to provide guidance because if all you do is develop software, obviously this has huge impact. But if you're a manufacturer, what falls under software development? Does embedded software fall under software development that's subject to 174 now? Does PLC programming fall under it? Does your ERP system that you've contracted out fall under this provision, especially if you've contracted out to developers in a foreign country? And the answer is there's a lot of facts and circumstances arguments. I'd say that in most of those cases, they don't qualify for one reason or the other, or they may not qualify as 174. So this is another area where Treasury is going to provide some guidance, and it's going to be relevant for pretty much anyone in business today because we are all, in some sense, software developers, or at least we contract it out. That takes us to our third polling question. To confirm your attendance, please. All right. So here are the numerical examples. We're going to assume there's a taxpayer out there who is taking the alternative simplified credit for research credit purposes, and they're making the reduced credit election, so they get that 21% haircut. We're going to assume they have $1 million in qualified research expenses, which are identical to their 174 expenses every year. So in year 1, they amortize $100,000 of R&E expenditures. Wait, it was over 5 years. It is over 5 years, but it starts in the midpoint of the first year. So in year 1, you get 10% of $1 million. Year 2, you get 20%, all the way through year 5. In year 6, you get the remaining 10%. So it's 5 years of amortization spread over 6 years, kind of like how it works for depreciation purposes when you don't have 100% bonus. So compared to where they were the year before, this taxpayer now has $900,000 more in income. 37% tax rate, that's $333,000 in additional tax. But there's more. They're still taking the research credit. With these facts, that's $55,300. So they have a net increase of about $277,000. The research credit is a primary way to offset the amortization. And the key point for this slide is that they don't actually end up in a position that's, I call it equilibrium. They don't end up in a position as good as 2021 until 2026, year 5. That's a year where the additional tax from the amortization is finally smaller than the research credit. And this is why people don't like this, because the research credit is an incentive, and now amortization is punishing the companies that America needs most to do research and development. Now, here's that same exact example, but no reduced credit. So with no reduced credit, that means the credit's 70 grand instead of 55,000. So because of the way the add back works now, and we have an example in a second, you're actually better off doing this, assuming Congress doesn't change the rules. And you have the same basic logic. You're not in a good position till year 5, but you're better off than you were taking the reduced credit. Then we have this third example, and it's kind of confusing. So assume you had $1.5 million in taxable income. You have $1 million in research expenditures. So in 2022, you have $100,000 in amortization, which means, thinking back to the last couple of slides, you have $900,000 in taxable income. Because we're assuming that you deducted everything on your books, and now you have this big add back. So you end up with $888,000 in taxes due. That is not good. And in this example, we're assuming that the gross R&D credit would be $140,000 and that the reduced credit would be $110,000. There are situations where you could have a credit that high. So the difference with the add back is under the new rules, you only have to add back, that is, reduce your amortization capital account, if the research credit exceeds your current year amortization on qualified research expenses. So in this circumstance, the amortization is $100,000. The gross credit's $140,000. That $40,000 difference is what you have to reduce your capital account by. That's what the next part of the chart shows. $40,000 add back. Revised expenses of $960. So we revised the amortization down to $96,000 for the first year. Now, here's an interesting fact. Every practitioner who has looked at this agrees that the add back works like it does at the top, that the delta between 140 and 100 is the amount of the add back. Now, practitioners do disagree on when that add back happens. We take the view that it happens to all years and that you modify the capital account in year 1. Some people take the position that you reduce it after the amortization at the end of year 1. There are decent arguments for both positions, but it's good to point out everyone agrees that this is what you do and that the IRS instructions for Form 6765 this year are wrong. Interesting thing, come down to the very final result, you're still better off, even if with an add back, taking the gross credit. So the procedural guidance. I'm not going to spend too much time on this, except to say, if you had a short tax year in 2022, as long as you included all your proper Section 174 costs on the depreciation and amortization form, and you filed your return before January 17th or on January 17th, you're deemed to have made an automatic method change. It's nice. If you're a calendar year taxpayer, you didn't make that deadline for your short tax year, you have to attach a white paper statement to your return that gives very simple information: your name, your EIN, the designated change number of 265, a qualitative and quantitative accounting of the capitalized costs, the beginning and ending dates for the year of change, and a declaration that you made the change on a cutoff basis. That is, you just considered costs starting on 1/1/22. That's straightforward. After your first year post 2021, you have to file 3115. Like if for some reason you thought you weren't required to adopt 174 and it turns out you are. Now, the bad news is you don't get audit protection for 2022 in that circumstance if you wait till 2023. But you do, you are allowed to make the change that way. Shouldn't do it for a variety of reasons, but you should make the change right now in your first 2022 year. You never get audit protection for pre-2022 years. It's just the way they've written the guidance. So what are our recommendations? Well, we suggest everyone comply with the law as written. This will limit the possibility of future interest and penalties, and that could include preparer penalties if your preparer makes mistakenly allows you to stay on a expensing method. So that's an important point. I mean, practitioners have skin in the game here. Monitor the effective date of any transitional guidance. Like I said, the service is probably going to make this effective for 23, maybe even 24 when they issue guidance, but they'll probably allow early adoption if it's beneficial to you. It's not too late. Reach out to your congresspeople, your representatives, your senators. Let them know how this law is affecting them. Give them hard numbers. If you're doing tax planning, keep in mind, if you're subject to 163J, you now have more taxable income, so the interest limitation should be higher. If you get the pass-through deduction, the qualified business income deduction, you have more taxable income. In theory, that means you have more 199 Cap A deduction. Those two provisions, with the right facts, can help offset some of the negative effects of amortization. But the key thing is the R&D credit is still the most effective way, most direct way to offset the tax effects of amortization. So if you're getting a research credit study done for 2022, that is the best starting point for a 174 study. It is, let's see, and I paused because a question came in and I'll answer it in a second. Your QREs and your existing research credit study is the best place to start to decide where you're going to have amortization. Now, if you have gap numbers for research and development, that's another good starting point. And just finally, I'd like to reiterate that you can't just stop claiming the credit and pretend you don't have 174 costs. It's too easy to see through. The IRS, well, they don't have the best data analytics. They're getting better, and it's pretty easy for them to spot. So our question is, if we did the R&D credit for the past 5 years and don't do it this year, but do capitalize Section 174, is that still a red flag for the IRS? Not sure if the R&D credit was really worth all the work internally. So if you're capitalizing your 174 costs, I mean, to me, the gap between 174 and the R&D credit isn't so great that if you're doing one, it makes sense to do the other. It's more economically efficient to do that. And the credit is still the best way to offset the amortization. It's the most direct way. Not everyone gets the pass-through deduction. Not everyone is subject to the business interest limit. So this is an interesting question. It's actually a new one to me because I actually have not run into this yes, I've seen plenty of people who say, well, I just don't want to do either because neither one is worth it. But I assume that, for instance, if you had a gap number and you wanted to capitalize that, I do know that some of the largest accounting firms are letting clients do that with the hope that it gets fixed and they just capitalize their gap number. But then you wouldn't do the research credit study because that's an extra cost on top of it. And so if you dig through the history of the research credit, it's not actually voluntary. That if people frequently say it's voluntary, and it was. Briefly around 1988, Congress explicitly put in a rule that would allow people to elect not to take the research credit. But then that expired a year or two later, or they took it out, I forget which. It's been several years since I looked at that issue. But the net result is that the research credit is not actually voluntary. If they qualify, technically none of the credits are voluntary. Well, very few of them. But is the IRS going to complain? Of course not. I mean, the IRS doesn't care if you overpay your taxes that much. At least that's been my experience. So, final polling question. Do you need CPE credit? Yes, no question.
Yeah, Brian, I just on that last question, I'm just thinking about it. We have been working with Source Advisors on a software program that can be utilized to claim the R&D credit for smaller amounts that maybe
definitely
the benefit. Maybe the taxpayers, the clients don't think that the cost is worth the benefit. So there is an option that we have available, and we're getting into learning about it. So that is an option. Definitely feel free to contact us if you feel that maybe the R&D credit isn't really worth all the work internally for the benefit of it. So I thank you very much, Brian and Al, who has quietly been listening, but you know, these guys have been a great resource for us, and there's so much that you mentioned today that is so timely and important, and I wish we didn't have to do this, but it is good that somebody with your background and knowledge is at least hopeful. You mentioned that you're an optimist. I tend to be a little more pessimistic or conservative on these things, but I'm glad to hear, really glad to hear what you said. And a couple other things that you mentioned in there, I just want to point out the two extenders that you mentioned that may be included in a bill would be the bonus depreciation. You know, bonus depreciation is scheduled to 80% in 23, 60, 40, 20, all the way down to 0. That would be huge. And also the 163J business interest change. So we're right up against the noon deadline. So I thank everybody. If anybody has any questions, don't hesitate to contact me or anybody from the HBK Manufacturing Solutions Group team. Brian's contact information was up there too. I'm sure he wouldn't mind hearing from you, but we will be keeping you posted as this 174 amortization continues to develop, and hopefully it works out in everyone's favor. So Brian, Al, thank you so much, everybody, for listening. Also, thanks for being here, and we look forward to having you all back next month for our next webinar. Thanks.
Appreciate it. Thanks, everybody.